Hello and welcome to The Trade. It's great to have your company this Tuesday afternoon. I'm Kyle Rutter, of course. Now, well, we don't have any breaking news to cover this week, but we'll stick to the charts. Tony Sycamore from IG Australia joins me live via Skype. Tony, it was fun last week breaking, obviously, the BOJ shock decision to keep its yield curve control policy unchanged. It doesn't sound like we're going to get anything breaking on air today, but that's good because it'll allow us to stick exactly to the charts and the trade setups, because we're at a really interesting juncture, it does feel, especially on the S&P 500. We'll get that chart up first, but take us away at the moment what you're seeing here, because, well, that's a very, very closely watched trend line. Looks like it's on the cusp of breaking.
Yeah, and what great fun that was last week, Kyle. But as you said, it's always nice to stay to the script, and almost to the tune, the S&P 500 is also following the script in some respects. The widely watched trendline resistance from the 48.08 high from January last year is now being challenged. Ironically, coming at a time when the Fed has entered its blackout period, which means that we're getting none of that hawkish Fed speak that we've traditionally become used to. Having said that, the S&P had been brushing that off, and it did feel like the Fed were almost keeping a ball underwater. But here we are today. I think the 40.35, 40.15 area was the level to keep in mind. And you can see that it has now closed above there. So what that does for me is it opens up, if we get a confirmed break above or another close above here in the next 24 hours. Obviously, we've got a huge earnings season, a huge week for earnings. I think 27% of the S&P 500's market cap are due to report this week. But if we can see this break confirmed over the next 24 to 48 hours, it puts a couple of levels in mind. Firstly, the 41.80 high, which was very much a false break high, you can see there in December, and then the 43.27.5 high from mid-August. Now, one thing I was just looking at, which is quite interesting, in 2022, in January, the NASDAQ fell 8.53%. Here we are in January 2023, and the NASDAQ is actually up 8.53%. Admittedly, there's still a week to go, but if January sets the tone, then potentially that break holds.
Yeah, fascinating stuff. So, I mean, just to interlay some conversation here around the event risk this week, I mean, we've got a lot of data. We've got a lot of earnings coming up. Do you kind of sit to the sidelines in this situation, or are you looking to somehow be tactical with some of that event risk?
Oh, it's a tricky one. I mean, for me right here, you've got so much event risk. I don't really have any great insights into how these results are going to drop. I think the bar's set relatively low, so potentially companies like Tesla can jump over a very low bar. But you've also got inflation numbers coming out at the end of the week, and it makes it a really tricky proposition. I'd almost be happy for the S&P 500 to get through the next 3 or 4 days and still be trading maybe around 40.50, 40.75. And then you could say, look, we've got a good deal of those tech reports out of the way. We've got the inflation numbers out of the way, and potentially we get a little bit of clean air into the Fed's FOMC meeting in early February. Now, that's still going to be a big one for me. And it's interesting because the more that equities rally, the more that bonds sell off, the more hawkish it means the Fed have got to be to keep inflation expectations anchored. So really, at the very best, I think if you are looking for the rally to extend over the next week or next month, you need to be mindful that they are just not going to appreciate what's going on here in the background, and that could see them resume. Even if they do pause in a couple of months' time, they may need to start hiking rates again, particularly when we look at another chart, which I guess will be oil in just a few moments' time.
Yeah, really excited to get to that one because it does seem to be offering this dilemma right now about, potential reignition of some sort of inflationary pressure. But let's get to the ASX 200 next because it's also running higher today. And in fact, I'll just add to that candle that you've got there, which I did whip off, I should say to the audience, I whipped off Tony's report this morning, so it doesn't include today's rally. The market is very close to 7,500, which is really quite remarkable, especially me, who's on the wrong side of that. Tony, what do you reckon at the moment with the ASX 200? Because it seems to be a bit of a steam train at the moment. It's one-way trade.
Absolutely, been a steam train. And if you feel like you're on the wrong side of it, Kyle, spare a thought for the fund manager community out there. Generally, they take the first 2 or 3 weeks of January off to recharge, spend times with friends and family. And if you were a fund manager and you potentially moved to a more defensive allocation into the end of last year before Christmas, or you've had some new inflows hit your cash account in January, and you're looking at this ASX 200 up 6.5% or whatever it is in the first 3 weeks of January, what the heck do you do? It's a massive dilemma. Do you chase it at this level, or do you hope or wait for a pullback? Now, my preference has been that the ASX 200 would make a new high up above the December 73, 75 high. And once it got there, I have taken a view that you should be looking to trim longs up around 74.80, ahead of the 76.30 triple high that we saw last year. So for me, the preference now is you trim longs here. It's been a fabulous, fabulous run, very much well unexpected, but there is signs now that this market is becoming overbought. You can see the RSI's well into overbought territory. Plus, you're getting a little bit of bearish divergence there on the RSI, which means that the ASX 200 is making new highs, but it's not being confirmed on the RSI. So it's what we call bearish divergence. So for me, I am happy to be sort of taking some profit up here. It's done kind of what we thought it would do, probably to a degree more than we thought it was going to do. But right here, right now, I'm happy to take some profit on. And if we get the pullback, we're happy back towards 7,200 to 7,000 potentially. Or if it breaks above the 76.30 triple high, then you get another buy signal, because I think once the momentum guys get involved with the break above that 76.32 high, it could be quite a decent move there as well.
Interesting. And this question asks with more than just a pinch of self-interest, but we do have CPI tomorrow, positioning around those sorts of risk events, which could, potentially be fairly significant for RBA policy next month, and ergo how equities trade in the short term. I mean, are you looking to potentially de-risk around that sort of an event, or will you respond to that kind of event should it come in higher or lower than expectations?
I think the obvious play here is that if the number comes in higher than expected, it probably sees the rate market move. It's currently sitting at about 60% price for a 25 basis point rate hike on the Feb 7 RBA meeting. But if it comes in higher than expected, I know we're talking about peak inflation narrative here in Australia, and that potentially it follows the pattern we've seen in the US, in the Eurozone, in the UK, that inflation is about to turn lower, but certainly a higher than expected number. Looking at the trim mean, market's looking for about 6.5%. If that comes in around 6.7, 6.8%, be careful. I would again be taking more profit on the ASX 200 longs. Conversely, look, if we get a weaker than expected number on that trim mean, maybe around 6.2, 6.3%, then you would certainly say quarter four 2022 has been the peak in inflation in Australia. It does bring into conjecture whether the RBA will actually need to deliver that final or another 25 basis point rate hike in February, and that would probably support the ASX 200 into end of month. Now, bear in mind, end of month, which we do get next week, there's going to be a whole heap of funky FX and stock indice rebalancing flows. So keep that in mind as well for anyone looking to trade next week.
Yeah, getting one of those very hot Januaries to start the year. Rather bizarre, but I guess sentiment was very bearish coming into the year, almost the reverse of what we saw in 2022, of course.
It's amazing.
It is very interesting. Okay, so let's go abroad again, and we're going to look at, well, fittingly enough, especially given our conversations last week, the US dollar JPY, US dollar Japanese yen, and, well, structurally quite a clean downtrend there right now. However, well, you've identified there, as I can see, a potential level of trend line resistance. How are you seeing the setup here?
Look, what else can we say that's not on this chart? It's fallen 25 big figures from the October 151.95 high. It's found a base down there around 127.22. And we've had 3 days now where US yields have risen, so that certainly supports the dollar element of the yen. We had Kuroda a little bit dovish into the end of last week, and I think the market is still short dollars, long yen. Now, we know that when the market gets too far on one side of the boat, things can happen towards the other side. And the other side of this equation would be a break above, probably I think it comes in around 131, a little bit higher perhaps. But if dollar yen was to break above that 131 area, then I think we could see an unwind of a lot of those dollar yen shorts, which have been accumulated firstly on the way down, and secondly from that mid-Jan, the article we saw there, which we were discussing last week, Kyle, about the potential for another easing there or a widening of the YCC band, and it didn't come. And here we are. I guess they probably got out of jail a little bit because dollar yen flew last Tuesday when we were chatting and then came back down to earth. But here it is. It's still trying to push higher, and that 131, that trend line coming in around 131 looks very important to me.
Okay, so keep an eye out on that one, because it'll be another interesting one for broader currency markets too. Obviously, a part of the story there for the US dollar this year has been a resurgent Japanese yen. Okay, we flagged it before. We wanted to talk oil again. We spoke about it last week, and we discussed it really in the context of not just how meaningful this trade could be for oil markets, but also the knock-on effects to other asset classes. Take us through first, of course, just what you're seeing on the technicals here for West Texas Intermediate.
Yeah, it's such wide-reaching implications here. I'm not a crude oil trader myself, but I do like looking at crude oil because it has been in the news and it has been driving a lot of the fundamentals and the macro narrative over the past. Well, you can look at the last 12 months, but potentially even longer than that. And what you can see there, I think, is really, really interesting. Just from a technical basis, you can see there is potentially an inverted head and shoulders. I mentioned I like inverted head and shoulders. They're less watched than your conventional head and shoulders, which we often see highlighted in charts and on Twitter, etc. But it is now above that neckline. It hasn't really confirmed or denied the break. It's still sitting just below a 7-week low. Obviously, we have a large, many centres in Asia out, which will probably, you would expect them to potentially move crude oil around a little bit more in a session like we've got today, but there's just not a lot happening. So whether that break is confirmed or denied, the jury's still out. But look, if it's still here by the end of the week, then you're probably going to look at that and say, well, look, that is a confirmed break. $93, here we come. What does that mean for inflation? Well, we don't need to tell the folks what that means. It means that inflation probably, just as we're all getting on the peak inflation narrative, potentially there's a spanner in the works coming there through crude oil. And also natural gas had a good night as well last night, up about 3%.
Yeah, okay, so energy markets really shifting. Fascinating dynamics, of course, too, across the globe when it comes to coal and what have you. So, I mean, again, this is where I guess the cross-market analysis can potentially come into it. Maybe it's not something relevant to your trading necessarily, but I mean, if you start to see a bit of a breakout to the upside with crude, we actually are seeing long-dated bond yields climbing, especially in the United States, despite the fact that we've got tech stocks rallying too. You start to get a little bit wary of an equity rally that might need to pull back or perhaps readjust a little bit if we do get that sort of shift in inflation expectations and yield dynamics as a result as well.
Yeah, as you said, yields have risen for the last 3 sessions and tech stocks seem to be brushing it off, ignoring it. Yeah, it's certainly something to be watched for. Crude oil, it's been driving sentiment across the board. What else can we say? I mean, you just have to watch that. $93 probably isn't a pain, it's an irritation, but if it got back above $100, that would certainly cause, all of those narratives which we saw coming out around this time last year, crude oil going to $200. Well, I don't think we need to worry about that, but up around $115, $120, that certainly unwinds a lot of the cooling in inflation that we've seen, at least at a headline level, and it also flows through into food as well, because we know that fertilizer prices, they're driven by things like natural gas, etc. So, yeah, we've got to watch it because of the implications on the wider complex.
Yeah, and we'll have to keep an eye on things. It could be interesting. I think we were saying it again last week as well. The kind of similarities this has to potentially that kind of 2017 into 2018 market, I do believe, if my memory doesn't escape me, where we did have a very big sort of melt-up, a mini melt-up in risk assets before what was a little pocket of volatility at the end of January and start of Feb. So could be exciting. We'll see how we go. Things are fairly positive out there, but really appreciate your insights, Tony. Me in particular on a day like this. Tony Sycamore, IG Australia. We'll talk to you very soon.
Thank you, Kyle.
All right, well, that does do it for this edition of The Trade. Be sure to tune in tomorrow. We'll have another massive episode of The Trade. Thank you so much for watching.
The Trade is brought to you by ACY Securities, Tim Cahill's official FX and CFD trading partner.